Picture this. It is April. You are sitting at your dining room table with a stack of papers in front of you and a cup of coffee that went cold an hour ago. You're staring at your pay stub, doing the math, and feeling a slow burn creep up your spine. You grinded through an entire year. Early mornings, skipped vacations, deadlines that ate into your weekends. And now, running the numbers, you realize that somewhere between 3 and 4 full months of that grind went straight to tax bills you never got to vote on. There is a familiar sting in that realization. You have been raised to accept it. Taxes are the cost of a functioning society, right? That's what everyone says. But then your phone buzzes, a news notification. Some tech founder just had his best financial year ever, and his effective tax rate is lower than yours. Not lower than a hedge fund manager's, lower than yours, a regular salaried professional. And something in your gut tightens because it does not add up. You work hard, you pay your share, and somehow the people with the most pay the least. Here's what I want you to understand before we go any further. That is not a glitch in the system, it's a feature. These people are not cheating. They are not hiding money in offshore accounts or doing anything illegal. They are operating under a completely separate financial logic, one that was never explained to you in school, never covered in your personal finance class, and rarely discussed openly in mainstream media. Today, on Nora Invests, we are going to pull back the curtain on that logic. It's called Buy, Borrow, Die, and by the time this video ends, you're going to see your entire relationship with money differently. Let's start at the root of the problem. There are two fundamentally different ways to receive money in this economy. The first is earned income. That's what most of us have. You perform work, someone pays you, and the government immediately claims its portion before the money ever reaches your hands. Federal tax, state tax, payroll deductions, gone before you see it. What lands in your account is what remains. Financial educators sometimes call this the W-2 trap, and the name fits perfectly. You are exchanging hours for dollars, and those dollars are taxed at the steepest rates in the entire tax code. That's the game most people are playing without even realizing there is another game available. The second way to build wealth does not involve selling your time at all. It involves buying assets that grow in value while you sleep. This is phase 1 of the Buy, Borrow, Die framework, and it's simply called Buy. Wealthy individuals do not obsess over their annual salary. They're focused on something entirely different: net worth. They take available capital and direct it into appreciating assets, stocks, real estate, private businesses. And here's the piece of the puzzle that most people completely miss. When those assets go up in value, nothing is owed to the IRS until the moment you actually sell them. That growth, sitting quietly inside your portfolio or your investment property, is called an unrealized gain. It's yours on paper. The tax clock has not started. If you purchased shares at $100 and they climb to $1,000, that $900 gain is invisible to the tax system for as long as you hold on. It just sits there, compounding year after year, building on itself in complete silence. This is precisely why you see news headlines about a billionaire whose personal fortune grew by $8 billion in a calendar year, yet the IRS received virtually nothing from them. That wealth is not sitting in a savings account. It lives inside assets. And the foundational rule of this strategy is you do not sell. You never trigger the taxable event. You let the snowball roll. But now comes the question I know you're already asking. If all their wealth is locked inside stocks and buildings and they never sell anything, how do they actually fund their lives? How do they pay for the house and the trips and the everyday expenses? This is where phase 2 enters the picture, and it's genuinely the most counterintuitive part of the entire strategy. It's called borrow. Everything you were probably taught about debt frames it as something to be avoided, eliminated, feared. But for the financially sophisticated, debt is not the opposite of wealth. It's one of the primary tools for accessing it. Here's the mechanics of how it works. Instead of selling $20 million in stock and handing a large chunk to the government in capital gains taxes, a wealthy investor walks into a private bank and uses that $20 million asset base as collateral for a loan. The bank sees a $20 million asset base and comfortably extends a $10 million line of credit at a low interest rate. The investor receives $10 million in liquid cash, and here's the crucial detail. Loan proceeds are not classified as income under the tax code. The IRS does not see that transaction. Zero income reported, zero taxes paid, $10 million of purchasing power completely untouched by taxation. Now, you might raise a fair objection. What about the interest on the loan? Does that not eat into the benefit? It does exist, but the math still strongly favors the borrower. Imagine the loan carries a 4% interest rate. Meanwhile, the underlying portfolio continues growing at an average of 9 or 10% annually. The investor is effectively generating a net positive return on borrowed money, while their own capital never stops compounding. This concept is called positive arbitrage, using someone else's money to fund your lifestyle while your money stays in the market, working for you around the clock. Contrast that with the standard approach. You earn income, lose 30 or 40% to taxes, invest what remains, and try to build from there. The wealthy are skipping that tax subtraction entirely. Their entire capital base stays intact and invested. Every single dollar is working every single day. Now we arrive at the third and final phase of the strategy. It is called die. I understand that sounds blunt, but estate planning contains what may be the single most powerful tax provision in the entire United States tax code, and most people have never heard of it. You might be wondering what happens to all the debt that accumulates through decades of borrowing. Does it not eventually become a problem? The answer lies in something called the stepped-up basis, and it is the closing mechanism that makes the whole system perpetual. Here's a concrete illustration. Imagine your grandfather purchased stock 40 years ago for $15 per share. Today, that same stock trades at $600. If he had sold it a week before passing away, the $485 per share gain would have been subject to capital gains tax, a potentially enormous bill. But when that stock passes to an heir through inheritance, the cost basis is legally reset to the current market price. In the eyes of the IRS, the heir purchased those shares at $600. Every dollar of gain that accumulated across 4 decades simply ceases to exist as a tax liability. It is permanently erased. The heir can liquidate those shares immediately and own nothing in capital gains. So the cycle completes itself cleanly. The heirs receive the asset base with a fully stepped-up basis. They sell a calculated portion to repay whatever loans funded the prior generation's lifestyle. Because the basis was reset, that sale generates no taxable gain. The debt is cleared, the family retains the overwhelming majority of accumulated wealth, and the entire cycle begins again. Buy assets, borrow against them for living expenses, and allow the tax slate to be wiped clean at death. It runs like a self-perpetuating wealth engine that never intersects with the tax obligations that the salaried workforce faces every single year. This is not a minor loophole. This structural advantage, compounding across generations, is a significant reason why wealth inequality has accelerated so dramatically. The middle class earns money, pays taxes, saves what remains, and tries to grow it. The wealthy accumulate assets, access liquidity through debt, and never trigger a tax event. The tax code rewards capital. It penalizes labor. That is not an accident. It is an architectural choice, and being frustrated about it is entirely reasonable. But frustration does not move the needle on your net worth. Understanding the rules does. Now, I want to address something directly. You might be thinking that this framework only matters if you have millions already, that Jeff Bezos can call a banker and unlock 9 figures. But what does any of this have to do with you? More than you might think. The underlying logic of buy, borrow, die scales downward. You do not need a 9-figure portfolio to begin shifting your financial behavior toward these principles. The starting point is a mindset reframe around debt, specifically the difference between debt that depletes and debt that builds. Consumer debt, borrowing to fund cars, clothing, vacations, things that depreciate or disappear, is the kind of debt that keeps the average household running in place. It has no upside. But investment debt, borrowing to acquire assets that appreciate or generate income, is the engine the wealthy use to expand their holdings without depleting their existing capital. Consider your home. For most households, it's the largest single asset on the balance sheet. Most people treat it as a savings vehicle to be paid off as fast as possible. but a strategically minded homeowner watches that equity grow and recognizes it as accessible capital. A home equity line of credit allows you to borrow against that appreciated value, tax-free without selling, and deploy that borrowed capital into income-generating investments. A rental property, an index fund, a small business. You are now practicing a scaled-down version of the exact same borrow phase that the ultra-wealthy execute at 9 and 10 figures. This requires dismantling a deeply ingrained belief that carrying debt is inherently reckless. The distinction that matters is what the debt is pointed at. Wealthy individuals often carry enormous amounts of debt, but virtually all of it is structured against appreciating assets. They use leverage not because they lack cash, but because leverage allows them to control large asset bases with smaller amounts of their own capital and keeps that capital working in the market rather than sitting idle. If you maintain a taxable brokerage account, many brokerages offer margin facilities that allow you to borrow a portion of your portfolio's value. Used carefully and conservatively with full awareness that margin calls are a real risk in volatile markets, this is one way to access liquidity without selling positions and incurring capital gains. Instead of liquidating shares to fund a down payment or cover an unexpected expense, you borrow against the portfolio, preserve the investment, and avoid the tax event. There is another concept worth naming here: phantom income versus phantom obligations. When you own assets that appreciate without selling them, you are accumulating invisible, untaxed wealth. That is phantom income working in your favor. Most middle-income earners, by contrast, carry what might be called phantom obligations, recurring monthly costs like lease payments, streaming subscriptions, and installment plans that quietly drain cash flow without ever building anything on the asset side of the ledger. The strategic goal is to invert that equation, accumulate assets that grow without triggering taxes, eliminate the lifestyle drains that consume income without building value. It is also worth understanding how inflation fits into this picture. When you borrow money, you are receiving today's dollars with a commitment to repay in future dollars. If inflation runs at 3% and your loan interest rate is 3%, the real cost of that borrowing is effectively zero because the dollars you repay are worth less than the dollars you received. Wealthy asset holders benefit from inflation on two fronts simultaneously. Their real assets rise in price alongside inflation, and the real value of their debt obligations shrink over time. The middle-class saver holding cash loses on both ends. Savings are eroded by inflation, and there is no investment debt that cheapens with time. One group is positioned with the current, the other is paddling against it. Saving your way to financial freedom is a myth in a system built on perpetual monetary expansion. The only viable path is to own assets and use leverage intelligently to amplify their growth. Yes, leverage carries risk. That needs to be stated plainly. When borrowed money is used to acquire assets that then decline significantly in value, the damage compounds quickly. This is exactly why the truly wealthy obsess over risk management alongside wealth building. They maintain diversified portfolios. They hold strategic cash reserves. They set clear limits on how much leverage they carry relative to their asset base. Leverage is a multiplier of gains and of losses. The discipline is in using it with precision, not abandoning it out of fear. Before you can layer strategy on top of foundation, you need the foundation. That means an emergency reserve. It means a steady primary income stream. It means not borrowing to speculate on assets you do not understand. But once that foundation is solid, playing it cautiously becomes its own form of risk, the risk of never building the asset base that makes this strategy possible. One practical consideration worth raising is the structure of your investment accounts. Tax-advantaged retirement accounts are valuable, but they come with rigid rules, contribution limits, and restrictions on how capital can be accessed and deployed. A taxable brokerage account, by contrast, offers flexibility, the ability to borrow against holdings, to harvest tax losses strategically, and to access capital on your own timeline. Many high net worth individuals deliberately build substantial taxable accounts precisely because of the optionality they provide. If your entire investment portfolio is locked inside accounts the government controls, you have limited ability to execute the borrow phase of this strategy. Think about what financial advisors call tax drag. Every time you realize a gain and pay taxes on it, you remove a portion of your compounding base permanently. Over 30 or 40 years, losing 25 to 30% of gains annually does not reduce your final net worth by 25 to 30%. The compounding effect of that recurring loss means your final net worth could be cut nearly in half. The buy, borrow, die strategy is fundamentally about eliminating that drag, keeping 100% of your capital fully deployed 100% of the time.
The identity shift underneath all of this is significant. Most of us are trained to think of ourselves as earners, people who generate income through labor and manage expenses with what remains. The mindset required to execute this strategy is different. It is the mindset of a capital allocator, someone who thinks not about how to increase their salary, but about how to grow their asset base. Not about paying down all debt, but about managing debt strategically. Not about what the IRS will take, but about how to build wealth within the full range of what the tax code permits. The structure of the tax code is not going to be redesigned in your favor anytime soon. Waiting for a political solution to a structural problem is not a strategy. Understanding the rules as they currently exist and aligning your financial behavior with the incentives they already contain is. And the incentives are not hidden. The tax code actively rewards people who invest capital, build businesses, and take on productive risk. It penalizes people who trade time for salary and hold cash. The government has effectively published a map of how to reduce your tax burden. Most people never read it. The beautiful truth about this strategy is that it does not require exceptional intelligence. It requires patience, consistency, and discipline over time. You will not be able to borrow against a $500 brokerage account, but if you spend the next decade making deliberate, consistent decisions to accumulate assets instead of accumulating liabilities, the math will eventually reach an inflection point. Your asset base will grow large enough to provide the liquidity you need without ever requiring a sale. And when you reach that threshold, when you can fund your life through borrowing rather than earning and selling, you have achieved something genuinely rare: financial independence that the tax code cannot touch. Do not let a fear of debt keep your net worth frozen. Do not let an income-focused mindset distract you from the real lever, which is assets. Begin where you are. Put the first investment into an index fund. Explore that first rental property when the time is right. Build the habit of acquiring rather than consuming. Hold the assets. Never sell unless the strategy demands it. And when you need access to capital, learn how to unlock it without handing a percentage to the IRS. That is the architecture of generational wealth. It is not mythology. It is not reserved for people born into privilege. It is a logical framework built on how the tax code actually works, and it is available to anyone willing to understand and apply it. The tax code at its core is a list of incentives. It rewards behaviors that the government wants to encourage: investment, business creation, and productive risk-taking. It penalizes people who trade time for salary and hold cash. The government has effectively published a map of how to reduce your tax burden. Most people never read it. The beautiful truth about this strategy is that it does not require exceptional intelligence. It requires patience, consistency, and discipline over time. You will not be able to borrow against a $500 brokerage account. But if you spend the next decade making deliberate, consistent decisions to accumulate assets instead of accumulating liabilities, the math will eventually reach an inflection point. Your asset base will grow large enough to provide the liquidity you need without ever requiring a sale. And when you reach that threshold, when you can fund your life through borrowing rather than earning and selling, you have achieved something genuinely rare: financial independence that the tax code cannot touch. Do not let a fear of debt keep your net worth frozen. Do not let an income-focused mindset distract you from the real lever, which is assets. Begin where you are. Put the first investment into an index fund. Explore that first rental property when the time is right. Build the habit of acquiring rather than consuming. Hold the assets. Never sell unless the strategy demands it. And when you need access to capital, learn how to unlock it without handing a percentage to the IRS. That is the architecture of generational wealth. It is not mythology. It is not reserved for people born into privilege. It is a logical framework built on how the tax code actually works, and it is available to anyone willing to understand and apply it. The tax code at its core is a list of incentives. It rewards behaviors that the government wants to encourage: investment, business creation, and productive risk-taking. It penalizes people who trade time for salary and hold cash. The government has effectively published a map of how to reduce your tax burden. Most people never read it. That's the Nora Invest blueprint for today. If this changed how you think about taxes, wealth, and assets, share it with someone who needs to hear it, and subscribe for more financial frameworks that the textbooks left out.